All righty. Good afternoon. Thank you for joining us. My name is Elisa Douglas, Director of Alumni Engagement and Programs at Columbia Business School. Welcome to our CBS Faculty Live virtual talk. This virtual series brings our CBS thought leaders to you no matter where you are located. We are extremely excited to have Professor Abby Cohen returning as a speaker featured in this series. Many of you may know that she joined us just 1 year ago as the first speaker when this series launched. So thank you for coming back, Professor Cohen. In just a moment, we will hear from her and she will share her insights on the outlook for the global economy and financial markets in 2026. She'll take this next hour to present, and then we'll open it up for Q&A. During that time, please use the Q&A function to submit your questions. Abby Joseph Cohen is Professor of Business in the Economics Division at CBS. She was previously a long-standing partner and Chief U.S. Investment Strategist at Goldman Sachs. She was also president of the Global Markets Institute at Goldman Sachs, which provides research on the intersection of economics, public policy, and financial markets. She began her career as an economist at the Federal Reserve Board in Washington, D.C. Now it's my pleasure to hand it over to Professor Abby Cohen.
Elisa, thank you very much for that nice introduction, and also welcome to all of the alums who are on the call today. I'm going to do my best to keep my comments brief so that we have an opportunity for Q&A. And as Elisa mentioned, what you need to do is to put your questions into the chat function, and we'll try to address as many of them as we can. In preparing for today's discussion, I went over the notes that I had put together a week ago, and what I had thought would sound like analysis and forecast, unfortunately, turns out to be headlines. Because over the last several days, there has indeed been a significant change in attitude and a performance in all financial markets. But let me start at the beginning, if I may. I always do my work by beginning with fundamentals. What's happening in the economy? What's happening with regard to corporate performance? I then add on the layer of government policy decision-making, and then finally come up with some views in terms of financial markets. When I teach the course here at Columbia, the focus is very much global economy, global financial markets, and I'll touch on some of that here. But given the limited time we have, I'm going to begin with the United States. Obviously very important because most of us are located here, but of course, the largest financial markets in the world. And so much of what happens in the US markets will in fact have an impact globally. So what do I see happening right now? And what should we be looking for? When I look at the economy, I always think about demand. I look at inflation and the impact on interest rates. And of course, what does this mean for corporate performance? And where we are right now, unfortunately, is that the data are all pointing to weakening demand in the United States economy. That means GDP growth, not negative, but slowing. So not a recession, but certainly not as robust an environment as we had had previously. And we're seeing impact in several categories. Most importantly, we see it for the consumer. And I'm sure you've heard, if you read the financial press or you listen in on some of those programs, you know that the discussion now is all about the K-shaped economy. That is, there's one part that's moving upward strongly, and that tends to be individuals and families at the upper end of the income spectrum. But those in the middle and below the middle are not doing well, and they're moving lower. This is where we see weakening consumer demand, because this is also where we're seeing problems as it relates to jobs and credit. You know, we're kind of flying blind right now because of the government shutdown and the decision by the administration to not continue data collection during that period of time. By the way, in previous shutdowns, the BLS and other government agencies did continue to collect their data. But right now, we're not quite sure about some of those data series that we have come accustomed to relying on, but it would appear, using anecdotal information, that we are not seeing the sort of job creation that we had enjoyed as recently as 6 to 12 months ago. We're not seeing large job losses in aggregate being reported, but nor are we seeing job gains. And by the way, what I'm most concerned about is there's this K-shape, not just with regard to the consumer, but also with regard to companies. Large companies seem to be doing okay. Large companies have resilience. Large companies have flexibility. Where we are seeing companies being shuttered and where we are seeing job losses occurring are really smaller companies. By the way, they're the ones who are having the hardest time dealing with the increase in tariffs. Large companies, if they're facing an increase in tariff, can go through several layers. They can push back on their suppliers and tell their suppliers to absorb some of those tariff increases. They can also push down to different levels of their customers. And so the impact on a large corporation is not as significant as it is, for example, on the small retailer down the street who is typically directly importing from abroad or perhaps through just one layer, and they don't really have that kind of pushback either to their supply chain or to their customers. And so this is where we're seeing the biggest impact. Let me spend one more moment, if I may, about the problem with regard to this absence of data. The Bureau of Labor Statistics accumulates information on the labor force. As I mentioned before, they're also the ones who accumulate the information on inflation. And there will be at least a 1 month, maybe a 2 month period in which we don't have the usual data sources available. Now, is this a problem? I spent time a week ago with two individuals who previously headed the Bureau of Labor Statistics to talk to them about some of the details. For example, could you impute what the missing inflation data would be? And the answer is no, you really can't. Once that information hasn't been collected from stores, from factories, and so on, you can't make it up. And so does it matter that we don't have CPI data, for example? Well, really does. Why? Think of it this way. U.S. inflation data, CPI at the center of it, often determines Treasury interest rates, right? Treasury yields. And that is the benchmark for all interest rates in the United States. So if your benchmark is a little bit fuzzy, what happens when you try to set interest rates for corporates? And by the way, other sovereign issuers, other countries, also benchmark off the US Treasury. So the absence of data is more than an inconvenience. It adds a level of uncertainty to credit markets around the world. Now, hopefully those data will get restarted and we'll have a better sense of where we truly are. Although I think it's clear that market participants are basically saying that the information from the White House, which suggests that things are fine, inflation is going down, that is not consistent with the other information that we're getting from other sources. The next thing that I look at with regard to the overall economy is labor. And again, the Bureau of Labor Statistics basically put on furlough during this period of time, has not been collecting information. So again, we rely on anecdotes. And the thing that is very, very clear from a lot of the other information is that there is increasingly a shortage of workers in the United States. Prior to the pandemic, for example, in that decade before the pandemic started, 60% of the new workers who joined the U.S. labor force were immigrants. And before you think about, well, who are these people and what type of jobs are they taking, I would basically say that it's not exactly the way it gets portrayed in the headlines. Yes, there are many people who come in who don't have high education levels, and they're taking low-end service jobs. But the United States has also been a magnet for highly educated people who are at the upper end of the income spectrum. The United States has benefited from significant incoming with regard to not just foreign students, but also people with significant advanced degrees. For example, two-thirds of the working PhDs in the United States in categories like engineering, applied science, medicine, and so on, almost two-thirds of them are immigrants. Not children of immigrants, but immigrants. Something that we have been seeing most recently is that a lot of these people are not coming in the same numbers that we had seen before. Part of it has to do with the erratic policy that has been announced by the US government. For example, their employers are not certain about whether that $100,000 visa expense applies to their incoming workers. Does it apply to the foreign workers who are already here? Does it apply on an annual basis? To which categories of occupation will it apply? There's an incredible amount of confusion, and while this is getting sorted out, while the details are being announced and adjusted and so on, we are seeing a decline in incoming legal immigration from these high category people, and this is having a deleterious effect on the US economy. Now, when we look at forecasting, we start with the economy, and then I also take a look at different elements of government policy. It was mentioned before that I spent a lot of time in my career on Wall Street trying to blend economic developments with policy developments. And those policy developments typically fall into four different categories. There's monetary policy, fiscal policy, trade policy, and regulatory policy. In the interest of time, let me go through these very, very quickly. First, let's start with fiscal policy. The most important thing to look at here is the so-called One Big Beautiful Bill. From the standpoint of analysis of what it does to our budget deficit, it's actually the One Big Ugly Bill because it dramatically increases the deficit. But let's not look just at what happens to the deficit. And the deficit is a percentage of GDP, which is rising substantially. What are we using the money for? If some of that money was being used, for example, during a period of recession, one could understand going into larger deficit to offset the absence of adequate private demand, but that's not the current situation. We're not in a recession. Also, we would take a look at what is the money being allocated for? Is it being directed towards long-term investment in the US economy? For example, is it investing in education? Is it investing in science? Is it investing in infrastructure, public infrastructure? And the answer to all three of those is no. In fact, the bill that was passed and enacted into law actually reduces our commitment as a nation to investment in these things which are critical for long-term economic growth. That is investment in education, in science and technology, and investment in public infrastructure. So when we look at fiscal policy, my conclusion is we've moved in the wrong direction. What about monetary policy? You know, there's so much discussion about so much depends upon the Fed. Let's assume that interest rates are going down. In the marketplace, I think there was a realization that since inflation is not going down, it may be difficult for the Fed to move forward on a large number of interest rate decreases. And I think that Chairman Powell, made that clear a couple of weeks ago when he said the FOMC decision in December is not in the bag. It will depend upon the data, and there seems to be a mixed view of the voting members of the Federal Open Market Committee, some of them saying, let's be worried about inflation, others saying, let's be more concerned about the weakening of demand in the U.S. economy. In any event, they have some decisions to make in that regard. I'll come back to what this means for the equity market in a few minutes. But there has been a great deal of pressure, as you all know, on Chairman Powell, coming from the White House, coming from the Treasury Secretary, and so on. And I believe that that pressure has to do not just with interest rates. It also has to do with regulatory policy. Let's keep in mind that the Federal Reserve is, in fact, the prime regulator for the major financial institutions based in the United States. And by the way, the U.S. subsidiaries of major foreign financial institutions. And so there is a great drumbeat coming from the administration in Washington to ease up on regulatory policy. Maybe that's a good thing. Maybe it's not a good thing. We have to look at the details. I'll speak about that in just a moment. But keep in mind that when there is pressure on the Fed, and when we look at the discussion now about changing personnel, not just the chairmanship, but the other membership of the FOMC, that it's not just interest rate policy, it's also regulatory policy. So what does that mean? There are discussions underway about whether the so-called capital requirements now put on large financial institutions, the so-called GSIBs, perhaps they are too restrictive. They were put in place and increased following the financial crisis a few years ago. Maybe they're not needed right now. Maybe there can be some easing there. But there's also discussion that I find a little bit troubling. Excuse me. That has to do with the use of crypto on balance sheets. Is it possible to use cryptocurrency as collateral on balance sheets? I think it would be a grave error, but nevertheless, there are those conversations underway. Excuse me. I am in desperate need of a throat lozenge. So when we look at monetary policy, keep in mind that there are these different elements. There's also other regulatory agencies besides the Fed that are engaged in things that have to do with financial stability. And if you recall the financial crisis of 2007, 2008, it started with subprime lending, subprime mortgages, and also subprime credit provided to people purchasing automobiles and other durables. So what else do we see happening most recently that gives me pause and something I'd be watching? Well, one has to do with the elimination of the CFPB, that is the Consumer Financial Protection Board, which used to be housed at the Fed and is no longer. It was a financial crisis entity put in place to make sure that consumers were being appropriately treated. There is now it's very hard now for consumers to feel that they have these guardrails that are protecting them from bad practices from various entities. The FHFA, there are changes there. There are discussions underway as to whether crypto should be used for collateral for mortgages being provided by FHFA, basically Fannie Mae and Freddie Mac, which account for a very large percentage of mortgages in the United States. I, for one, am not happy with crypto being used at all for collateral. First of all, it's a highly volatile area. For collateral, typically you want things that are stable in value. So the variability in crypto is troubling to me. And furthermore, I don't know how much crypto is worth. So I don't know what sort of haircut should be put on it. Just take a look over the last week in terms of the decline in the price. I'm not even going to call it the value, but the price of various cryptocurrencies. So we've gone through fiscal policy, monetary policy, um, trade policy. Um, Trade policy, in my view, has not been has not been well conceived in this administration. I'm not saying that there weren't problems to be dealt with regard to unfair trade practices. Of course there were. I, however, prefer an approach of targeted tariffs and other things that can be done, other sanctions and so on, not these wholesale tariffs that have been put into place and then backtracked and then put back in place again. The erratic nature of these trade policies, I think, is not helpful. It's not helpful in terms of our relationships with other nations, and we rely on so many of them for other things, including our political and military alliances. I don't understand why we're not getting along better with Canada, for example. I think that the application of trade policy has not been well conceived in this administration. And this is something that worries me. As I mentioned before, large US companies can cope with it. Just give them the number of what the tariff is going to be, and they'll figure out what to do. They'll figure out where to put pressure on their supply chains or their customers and so on. Again, it's small and mid-sized US-based businesses that are going to have the biggest problem with this erratic application of tariffs, and also the fact that tariffs have gone up. One factoid, if I may, there's lots of discussion about, well, the tariffs that are in place now are nothing compared to so-called Liberation Day tariffs. That's true, except tariff rates on average have gone up 10 percentage points. That's a lot. A retailer that's working on a 2 or 3% margin and their cost of goods has now gone up an additional 10 percentage points, that is very problematic for them. So what should we talk about now? How about markets? What we have seen just over the last week has been a very significant increase in volatility across the board. And the thing that I look at with a great deal of interest is that some of the normal assumptions that are made about hedging, about lack of correlation, and therefore some protection in volatile markets just hasn't played out. So, for example, one of the arguments in favor of cryptocurrency has been, it will be a stabilizing factor. And it's turned out not to be. Crypto is trading with a very strong correlation to the so-called Mag 7 or the other large technology stocks, in part because the ownership is the same. If you have significant ownership in some Mag 7 stocks, for example, and maybe you've had a margin call during this period of time and you're looking for liquidity, where do you go? You go to other markets where you can raise some capital. So that's one issue. Second issue has to do within the equity market itself and the concentration of the Mag 7 and the other technology stocks. It's fun to watch on the way up. It's not so much fun to watch the implications on the way down. We're seeing that. And one of the things to keep in mind is that this concentration in these one or two sectors of the S&P 500, basically bringing them up to almost 40% of the total market capitalization of the S&P, has been that there is vulnerability. Now, these companies have performed well as companies thus far. But one of the things that I like to look at is under the hood. And we see something very interesting having developed here. And that has to do with what I would call, using the expression we used to describe the Tokyo stock market 2 or 3 decades ago, and that is cross holdings. One of the reasons the Tokyo stock market went up to astronomical levels, for example, a PE ratio of 120 times earnings, had to do with these cross holdings. These large companies all held each other's shares, and there was never a reason to sell. You basically, if you were the manager, you held on to those shares because it was a sign of good faith in the other companies until it no longer was. And during that unwinding period, the most important thing that happened is cross holdings were no longer viewed as good corporate governance. In the Mag 7 and in the technology sectors in the United States, we're seeing something akin to the cross holdings. Now, the PEs haven't gone to 120 times earnings, thank goodness. The PEs have stayed away from the astronomical levels. They're high, but they're not in the stratosphere, if you will. But there are cross holdings. There are also instances in which some of these companies are in fact providing the credit to their customers to buy more from them, and so on. And so if you're wondering why there is this downward movement, it's a little bit more than just the concentration of those stocks. It's also the concentration of their business relationships, and that's something to be looking at. With regard to market analysis elsewhere, we have seen over the last year or so a real belief that interest rates would be coming down, that the Fed would move those rates lower. That would be good for bond prices. It would be good for equity prices. For those who don't remember their equity market valuation, basically for a given level of earnings, if inflation and interest rates are lower, you're willing to pay more for those earnings because the discount rate is lower. And you think that that profit progression is going to last longer and those earnings become more valuable to you. If we are, in fact, in an environment in which inflation has been rising, and the Fed may be thinking again more closely about whether they will be lowering interest rates, equity investors have reason for pause, or at least they have reason for significant extra analysis. And that extra analysis over the last several months has been focused in on profits and profit margins. And here, for example, the technology stocks have performed extremely well. Most of the large cap stocks in the US have performed quite well. They have kept cost under control because, again, they've got some flexibility in managing tariffs. They have not been hiring large numbers of new workers. They have not been raising wages in a significant way. And so profit margins have been okay. And by the way, there have also been share repurchases by the large companies of their own shares. One of the things happening now in market psyche, and I'm not saying if this is going to be a one-week phenomenon or something that lasts much longer, but what is happening right now is a focus in on corporate profits, not so much that will be reported for the fourth quarter of this year, but rather prospectively for 2026. And so in the mind of investors, there is already this movement towards what's happening next year. Hence the title of our talk today, The Outlook for 2026. And let me go through that for you and then stop and let's have some questions. As I mentioned before, I don't think we're heading for a recession. And if the United States can avoid an economic recession, that will be extremely helpful for the rest of the world. However, the outlook is for more sluggish growth than we have seen before. Part of this has to do with the weakening of the U.S. consumer, particularly, again, in the middle and lower ranges, because these consumers are critically important for economic growth around the world. By the way, consumers, as I'm sure you've noticed, aren't buying stuff, but they are buying services. They're traveling. They are staying in hotels, at least thus far. We are seeing some weakening, however, in restaurant spending. But when we look out in 2026, we know that the U.S. consumer will not be as vigorous a support for global economic activity, number one. Number two, the tariffs are damaging not just economic growth in the United States, but they're damaging economic growth among our trade partners as well. We are seeing, however, that new trade alliances are growing up. So as countries lose their dependence on their economic activity with the United States, regional trade alliances are growing elsewhere, including in East Asia and South Asia. And so lessened correlation between those countries and the United States in 2026. The other thing to look at has to do with the outlook for inflation. One of the things that I find striking is that some of the White House argument in terms of why inflation is coming down is because of the hard views on immigration and tariff policy, which are slowing economic growth. And so the things that are being published by the White House basically kind of circular, which say, look at all the stuff we're doing to slow economic growth, and that's going to get inflation down. That to me is not actually a winning approach. You can always get inflation down if you push an economy towards recession. I think the better thing to do is to allow the economy to grow and find other ways to keep inflation under control. And one of those, of course, would be a more sensible trade policy. With regard to market outlook, it's hard to know where this year is going to end. But when we take a look at profit outlook for next year, it is tale of two cities. Large companies will likely be able to generate profit gains, high single digit or better in the United States. Small and mid-sized companies, too soon to know. And I think there will be wide variation by sector. When we look overseas, the issue has to do, number one, with their relationship to the United States and dependency. Number two, we see specifically that Europe is growing, but very slowly. East Asia, which had been doing quite well, economies like Japan, South Korea, and so on, they are having some negative impact in terms of weakening demand associated with the United States, but they're beginning to do within East Asia more trade among themselves. And China is a critical factor there. I'm no expert on China. I've traveled there many times, but I certainly wouldn't put forth my own independent forecast, other than to say that the Chinese, on an intermediate to long-term basis, are putting in place several things that should improve their long-term growth prospects. Right now, they're struggling with the following: demographics, population that's getting older, and not spending as much and as freely as they had before. The ongoing problems in the real estate and property markets and what that means for credit. And then, of course, weakening demand from the United States on tariffs, although getting around a lot of that through intermediate selling to other nations, which then come to the United States. And that, of course, is something that our trade negotiators are trying to work on to resolve in a meaningful way. But intermediate to long term, the Chinese are doing what the United States did in the 1950s. And that is, number one, to invest heavily in education, to invest heavily in public infrastructure, and to invest heavily in science. That was the secret sauce behind fabulous economic growth of the United States in the 1960s and beyond. China is now spending more than we are with regard to per capita expenditures in some of these categories, which is really, quite significant. And as we have actually reduced our government spending in things like scientific research, the NASA science research budget has been cut 55% under this administration. The NIH budget has been rejigged in a way that is not helpful. The NIST budget, which is like the science and technology version of NIH, is down to half of what it was, and so on. We're just not investing in the future the way that we needed to. And finally, public infrastructure. All of you went to school in New York City. Here I am in New York City, and we know that the infrastructure needs to be refurbished, as it does in many cities. New York was, the city that had the best infrastructure a century ago. If you have a subway system that was built more than 100 years ago, and bridges that were built in the 1930s and 40s, et cetera, things need to be upgraded. And yes, we do need a tunnel under the Hudson. And these are all categories where the current administration has actually cut back and reneged on federal programs that had been previously agreed to and financed. Other communities around the country are also dealing with this. If you don't have adequate public infrastructure, it's very hard to have companies and individuals perform at their best. And I would basically say, when I take a look at fiscal policy, I would much prefer that it be redirected towards these areas of investing in ourselves: education, science, public infrastructure. And the Chinese have decided to do that. And I think the United States has to get on the ball again, and make sure that we're doing what we should be doing for our own benefit. And with that, I'm going to stop. We have several minutes left for questions, and I'm going to ask Elise to go to the questions that have been put into the chat. I'm happy to address things that I spoke about or other topics that would be of interest to you.
Thank you so much, Professor Cohen. Okay, question time. So we do have an anonymous question here. We'll kick off with this. How do you assess the impact of rapid AI adoption on productivity, labor markets, and corporate earnings in 2026?
A fabulous question, and one that students often ask because they're trying to decide where they want to focus their attention and where they might like to look for their careers. So let me move forward and answer as best I can. I should indicate that although I have an undergraduate degree in computer science, my own knowledge about this is really based upon experts that I have access to. So let me give you a sense of it. I think that we make a mistake when we think that all AI is actually intelligence. Much of it that we have seen thus far isn't intelligence, it's just rapid data retrieval. Now, the thing about the large language models is the following. Previously, rapid data retrieval was limited to numbers. With LLMs, now it's words as well. The stuff can be rapidly retrieved and processed, but that is not necessarily intelligence. We have not seen very much intelligence, if you will, in terms of some of the commercial product. Where we are seeing better applications are those that have been developed by companies themselves for very specific purposes, because what they have discovered is that the very large language models, which bring in information from all sources, also have very high hallucination rates. So the companies that are reporting productivity enhancement from using this approach, they have built their own models based upon their own data for very specific applications. Where the applications make the most sense are things that are repetitive and rote. And so we think about clerical positions. We also think about things like simplistic computer coding and so on. There we are seeing that there are some reductions in force. But by the way, not all of the job losses being reported by companies are related to productivity enhancement. Some of it is related to overhiring in previous years. You may recall that 2 or 3 years ago, during the pandemic, there was enormous hiring that was done, basically just in case we need these people. And it turns out that in several instances, companies did overhire. But where are the productivity gains being seen? Where I indicated thus far. Something that is very important to keep in mind is that there's also a lot of, let's call it AI washing, where companies are saying, we're really into AI, we're really into productivity enhancement because it sounds good to mention that in investor calls. It sounds good to mention it in annual reports, but a lot of it is not, if you will, happening. Number one. Number two, some of it is money that some companies are not quite sure what they're going to get out of it. So these are early days. I don't want to sound like a Luddite on this. I am a believer in computer technology, given my own background, but obviously, early adopters are sometimes not the adopters who get the best benefit out of something. The expression we used to use is not leading edge, but bleeding edge. And so I would be very careful in assuming that all AI is great. I'll finish just with the following. There seems to be a very big difference between consumer applications, many of which are it's like an app on your phone. It's simplistic. It's not deep technology. The better bang for the buck, if you will, for AI investment seems to be these corporate developments, which are being generated by the corporations themselves in concert with some of the AI providers for unique and bespoke applications.
Thank you. Our next question is from Saeed Werner. How do you assess the recent rise of net asset value loans among private equity? Is this a risk? And also, Saeed says, regards from MIT.
Okay. Hello, MIT, and hello, other schools as well. I spend some of my time working with endowments for not-for-profits. This includes universities. And I had the good fortune early in my career to work with David Swensen on two of those endowments. And as you know, David Swensen was the godfather of investing in private assets and illiquid assets. And the argument was that long-term, these would provide better returns. And by the way, they did. But when the model was started, the Swensen model at Yale, and a couple of other places where I was on endowment committees with David, it was early on, right? Private equity was a very new category. And when an asset category is new, there are mispricings that one can take advantage of. I wouldn't argue that private equity is new. In fact, I am concerned about seeing all of the money that has been flowing into not just private equity, but now private credit, because if there's a lot of money flowing into an asset category, the mispricings may not be to the advantage of the incremental investor. I'm trying to say that politely. In addition, we have exited the period of extremely low interest rates. There was an extended period in which interest rates adjusted for inflation were close to zero, which meant money was free and easily available. And so some of the private equity investors, private credit investors, could find an investment that was generating 25 cents, double, use the leverage on it, and show the investor in your fund a 50-cent return. That is no longer possible. So I do think that we are in for a rough period now for private assets. They are indeed illiquid, which is creating other heartburn, if you will, for some of the investors in it. Now, there are still some wonderful managers in both private equity, private credit. I don't mean to suggest that there aren't, but I think that some of the marginal managers are not going to be generating good returns. And so the question relates to what are some of the hedges that can be put around some of these illiquid investments. And something that we're seeing more of is, basically putting on collars for some of the public equities that might represent, what used to be called pairs trading for some of these investments. But it is time to look much more carefully at these managers and make sure if you're investing with them that you've got the ones who really have a leg up and have the strongest analytical teams.
Thank you. Okay, we have a combination of related questions here, so I'll try to bring this all into one. Could you please comment on the UK, France, and Germany, all of which seem to have significant fiscal and regulatory problems that are impeding growth and innovation as well? They have deficit and a growing debt load. So, what do you anticipate from this in 2026?
Yeah, it's hard to speak about three very important countries as if they are one, but I'll try to do this efficiently. Germany, having the largest economy in Europe, has been unfortunately disappointing because there have been high hopes that they, among the others, would benefit from ongoing economic growth. But they and France have also felt a pinch, if you will, from what's happening with regard to Russia. I've not discussed the Russian invasion of Ukraine, which has had a deleterious impact on budgets, government budgets in Europe, and has had a deleterious impact on some of those economies because of the prior interrelationships between those economies and commodity trading and so on. The Germans also had tried something else that to address one, I'll call it an affliction or an obstacle, and that is in many developed countries, the US included, but also Japan and China for that matter. One of the issues is the demographic challenge of the aging of the population. And in the United States, we have, until recently, offset that with immigration. Let's keep in mind that if there aren't enough Americans in the United States paying into our Social Security system 20 years from now, we're going to regret not having the immigrants come in and move into our labor force. Well, the Germans have tried something similar. They opened up to immigrants, and it has created some political stresses in that country, including a movement toward the far right. In France, there are similar pressures. And of course, in the UK, there are the Brexit pressures. Let's keep in mind that much of what we're seeing now is a continuation of the stresses, the political stresses that were unleashed in 2007, 2008 with the financial crisis, which pointed out the difference between haves and have-nots in the various economies. And those disparities, if anything, have increased. They have increased in part because there are some people who work in industries and categories that have performed well and their compensation levels have grown. And then there are individuals who have had exactly the opposite experience, and it has created additional pressure. We see that not just in the three countries that were mentioned, but throughout Europe. The UK has even more special problems, and that has to do with Brexit, which was a self-imposed mistake, in my view. Why? Because why would you want to withdraw from a successful trade alliance? It has damaged many industries based in the UK, and we see it in financial services, right? London was the financial capital of Europe. And now, because they are in a different system than the EU, for example, we see that many institutions are now establishing banking relationships, not in the UK, but in France and in Germany. And London is just not the powerhouse it used to be. Now, why is that important? Because just like New York City is critical to the economic health of New York State, London was critical to the economic condition of all of the UK. And what I'm looking at here is as a percentage of total income, a percentage of total workforce, and so on. There are some interesting similarities between London slash UK and New York City slash New York State. London is having some issues. And I think the source of much profit growth and much tax growth in the UK has now decelerated, shall we say, and there has not been the benefit that the Brexit supporters had expected in the industrial portions of the UK. There has not been an uptick of the sort that had been promised by Brexit supporters prior to the vote. And so I think that helps explain the disillusionment, if you will, on the part of British voters right now. And my apologies for glossing over so many of the details. I'm just trying to give you, the general themes that I think are relevant here.
Thank you. Our next question is, are you still tracking the equity risk premium? If yes, where does it stand? Are valuations justified by earnings and growth? And this is from Brian Marshall. And
Okay,
he's a big
Brian.
fan.
Yeah, Brian, hello, nice to see you, or at least hear your question. I am not tracking or computing the ERPs myself, but I am relying on my former colleagues at Goldman Sachs, and also, by the way, the research teams at a couple of other firms to get their view on equity risk premia. And one of the interesting things is that the ERP basically, how much risk do we think is in the market and how much do we want to be compensated for it? That is, if there's a lot of risk, we want to be paid more, i.e., share prices decline. On that basis, the U.S. equity market was near the top of historical ranges, but not beyond it. I mentioned the P ratios before. That's not usually the way I look at it. With Tokyo at 120 times earnings and the U.S. mid-20s on the S&P 500. I do look at the equity risk premium, and I like to look at it by sector as well. So I would basically say it's looking more attractive now after a week of declines. What I worry about, however, is that while we didn't have a lot of valuation support a week ago for the market to move notably higher, we didn't have a cushion. And that was my concern. I always like to have investments in markets or assets where what's priced in is not perfection. What I want priced in is an uglier scenario, because it's the positive surprise that gives you the opportunity for gains. And maybe we'll be there if this continues for a few more days. But I think it's important always to look at those ERPs and looking at them in other nations as well. Basically, the U.S. was, toward the upper end because there had been confidence in the U.S. equity market. There had been confidence in those specific stocks. By the way, I keep talking about the concentration in Mag 7 and technology. Keep in mind that the technology industry is basically a U.S. industry. Other countries in Europe, for example, simply don't have the same level of exposure or expertise. One of the reasons their economic growth has dramatically lagged behind the United States. So you don't expect those PE ratios to be as high as they are in the United States. The other thing I do look at, of course, is ROE and ROIC, and the returns on equity in the United States remain higher than they are in other countries, which again is one reason why our valuations could remain higher.
Absolutely amazing. Okay, so we've come to the end of our time, sadly. Professor Cohen, thank you so much for being with us again and for this really informative and insightful talk. I'm remaining hopeful. And thank you to all our attendees for taking the time to be with us. We had over 200 of you join, and this was just wonderful to see. I'll just quickly plug our next CBS Faculty Live virtual talk. This will take place on December 3 at 6 p.m. Eastern with Professor Dan Wong. He will be speaking on From Shortcutting to Breakthrough, Empowering Classroom Discussion with AI at CBS. Professor Wong will describe how AI shortcutting led to his creation of Casey, a voice-to-voice AI discussion partner designed to deepen penetration and expand participation in the classroom as a novel mode of learning. So if you join us then, you will get to see Professor Wong demo Casey, and I believe it will be an exciting experience. So thank you again, Professor Cohen. Thank you all for joining. Have a wonderful day.